Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. Today is June 23rd, 2025. This is the Northbound Wealth Management Podcast. It's called Weekly Market Insights. Thanks for tuning in. Stocks were mixed during the holiday shortened week as trading uncertainty over the conflict in the Middle East weighed on investors. The S&P 500 index slipped by 0.15%, closing the week out at 5,967.84, which puts it up 1% for the month and 1.5% this year. The NASDAQ Composite Index rose 0.21%, closing out the week at 19,447.41. And the Dow Jones Industrial Average was flat, up about 0.02%. The MSCI EAFE Index, which tracks developed overseas stock markets, declined 1.54%. So what happened last week? Stocks rise, then they kind of slump. Stocks opened higher and oil prices fell as the start of the week, fell at the start of the week as investors hoped Middle Eastern tensions would ease. That certainly didn't happen with the U.S. Bombing Iran with bunker buster bombs over the weekend. However, as investors parsed through updates on the conflict, stocks fell over ongoing uncertainty. Conflicting statements from those involved, as well as world leaders, contributed to the uncertainty. Midweek, stocks rallied ahead of the Fed's interest rate decision. The Federal Reserve on Wednesday kept its benchmark lending rate unchanged for a fourth straight meeting to 4.25% and 4.5%, while sticking to its federal funds rate outlook for 2025. Amid higher inflation expectations, policymakers continue to see median federal funds rate at 3.9% at the end of this year, indicating potential easing in 2025. They raised their 2026 rate outlook to 3.6% from 3.4% projected in March and to 3.4% from 3.1% for 2027. Following the decision, Fed Chair Jerome Powell said policymakers are, quote, well positioned to wait, end quote, before moving on short-term rates. Powell indicated that trade policy has clouded the inflation outlook, making policymakers concerned about consumer prices. I've been critical of the Fed Chair Jerome Powell and have often remarked that his either rate hiking or rate cutting decisions have been at the wrong time and often linked to politics, despite his representation that he and his office are not political. It isn't difficult to see that his track record hasn't been good. By the way, markets seem to dismiss news that housing starts dropped unexpectedly to their lowest level in 5 years. And mind you, this is at the time of the peak season in home transitions. So again, begin lowering rates, Chairman Jerome Powell. You are late in doing so. Another Fed policy error. That's 5 over the past 7 years, contributing to 5 cyclical bear markets, in my opinion. Wednesday, Fed head day trading session was slightly down ahead of Thursday's stock market holiday. So let's keep going with this. The healthcare sector had the largest percentage drop of the week, falling 2.7%, followed by a 1.7% drop in communication services and a 1.2% loss in materials. Utilities, consumer discretionary, real estate, consumer staples, and industrials also declined. Decliners in healthcare included shares of Eli Lilly, which fell 6.9%. The company said it was planning to appeal against the UK's National Institute for Healthcare Excellence, or NICE's, decision not to reimburse the costs of Alzheimer's drug Kisunla under National Health Service. The drug maker said that the regulator's decision is unreasonable based on the evidence submitted by the company, clinical experts, and patient groups. Google parent Alphabet Shares led the drop in communication services, falling 4.6% last week. Google suffered a setback after the European Court of Justice Advocate General recommended that the court dismiss the tech giant's appeal to overturn an antitrust fine of 4.12 billion euros or 4.75 billion US. Google is also under investigation by Turkish competition authorities for allegedly using its Performance Max advertising platform to unfairly extend its dominance in the online advertising market. In materials, Steel Dynamics shares slid 5.7% as the steel producer forecasts fiscal Q2 earnings below analyst expectations. Energy had the largest percent increase on the weekly basis, climbing 1.1%, followed by a 0.9% rise in tech and a 0.8% rise in financials. The energy climb came as crude oil futures rose amid turmoil in Iran. Gainers included EQT, which rose 6.3%, and Valero Energy up 5.2%. Jabil was the top performer in the tech sector, jumping 17% on the week as the company reported Q3 diluted core earnings and revenue ahead of analyst consensus expectations and raised its fiscal 2025 outlook. Among financials, Coinbase Global shares, that's the custodian for cryptocurrencies, they soared 27%. The company said it had secured the markets in crypto assets license from Luxembourg Commission de Surveillance du Secteur Financier. Coinbase said the license allows it to provide crypto products to services to all 27 European Union member states. Following the holiday, anxious investors refocused on geopolitical tensions and developments as the week closed out. Investors appeared to take a risk-off approach heading into the weekend, which was smart because we bombed Iran on Saturday. So economic data, the Fed hold rates steady. Basically, that's like the main headline. Let's see. May existing and pending new home sales are going to be coming out. The second revision to Q1 GDP and the personal consumption expenditures index is a closely watched inflation measure for May that'll be coming out. So we'll be paying attention to all of that stuff throughout the week. Notable companies reporting earnings: Tuesday, FedEx; Wednesday, Micron; Paychex; Thursday, Nike. That'll be rounding it out. All right. So, tax tip of the week: how tax transcripts can help you file an accurate tax return. The IRS has a few resources to help you file an error-free tax return. They suggest making an online account to see estimated tax payments, prior year adjusted gross income, and more. They also offer the option to request a tax transcript online. There are 5 types of tax transcripts, each used for different purposes, so make sure you see the one that fits you best. A tax return transcript, for example, shows most line items for your original 1040. You can request a tax transcript online by mail or by phone. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. This tip was adapted from irs.gov. We got a good show for you. Stay tuned. So I was reading this economic research article by JP Morgan entitled Wars, Oil, and Global Growth. The global economy is absorbing 3 shocks: the U.S. trade war, Saudi oil supply boost, and Mideast war. And obviously there's a little higher threat of potential slowdown causing a potential recession in the second half of 2025. That's if, all of everybody's fears, maybe if 60% of all of their fears within this research cohort believe that it actually does play out, I guess. From most of what I'm discerning from these articles is basically, everybody's making adjustments like they're supposed to in the financial sector and in across corporate America and across political administrative cohorts. So I'm thinking that it's actually going to be not as bad as feared. I think people will make adjustments, and the worst case scenario is not going to play out when it comes to global recession fears. You still have a lot of tailwinds in different economies across the world. Obviously, the Middle East is kind of up in the air, but basically everything seems to be kind of in line. It's kind of like okay, a war. What's new? We've dealt with Russia, Ukraine for many years. Israel has been involved in a bunch of stuff. So I think the trade war that Trump implemented on April 2nd actually has a potentially worse of an impact than war from a financial perspective. Anyway, that's kind of what they were saying. We might get some oil demand and supply volatility, but it should stabilize over time as time goes on and more is understood about who's going to provide supply, and the Saudis look like they're going to be doing that. It'll be interesting to see how it all plays out, but we are going to be following it here at Northbound Wealth Management. So hopefully that gives you a little insight. Now, I do want to point to somebody who's been in the headlines. I did write about this on my blog about politics, about Jerome Powell and the Fed, and how basically they are working against the administration. They are being political, and they're not hiding it. It is absolutely ridiculous. This shouldn't be happening. They should be cutting by now. They're late to the game, and it just is sad that they've chosen to take this path because of fears of inflation. It's like, no, man, it's already gone. Move on, move past this. So I don't want to keep harping on him, but boy, is it frustrating to see. Now, when it comes to asset allocation of portfolios and things like that, I mean, stay diversified, go with the winners, stay with companies that have great free cash flow, that have good growth models, great management teams. So higher on the quality, less out in the speculative space. Treasuries are paying well, given that rates are up. But, Jerome Powell may lower a couple times in the back half of the year. He's just waiting too long, in my opinion. So I want to give a shout out to a guy by the name of Tom Bowley, Chief Market Strategist of earningsbeat.com. June 19th, he put this article out there, and I really like it. So I want to cover it for you. And it's entitled, "The Fed is Getting It Wrong Again as They Hold Rates Steady." Since that was last week, I do want to highlight what he was saying in his article. And he basically is saying the Fed should absolutely stop talking about being data dependent. That's so far from the truth, he writes. If they were data dependent, we'd have either seen a rate cut today or Fed Chief Powell would have been discussing one for the next meeting. Inflation reports since the last Fed meeting have been benign. Economic reports, on the other hand, have shown weakness and are pointing to the need for lower interest rates, which I agree with. I agree with what he's saying there. Powell was having none of it. During Wednesday's press conference, one reporter asked the Fed chief why the Fed was able to lower rates in December, despite knowing that tariffs and their potential impacts were on the way. I thought it was a great question because Powell was using future tariff impacts on inflation as the primary reason for holding rates steady today. It was a perfect illustration of what he has nicknamed Jerome Powell the waffler at his best, the waffler being Jerome Powell. I think this is absolutely hilarious for those in the financial industry. Totally agree with it. He is a waffler for sure. So laugh every time you hear that in talking about Jerome Powell. When another reporter asked Powell about his frequent comments that the Fed is data dependent and that all current data points to the need for an interest rate cut, the waffler noted the Fed needs to, quote, look ahead, end quote. So which is it? Is interest rate policy being guided by current data or by looking ahead? This is a repeat of the 2021 and 2022 period. Remember that all the inflation news and how the waffler, Jerome Powell, said inflation was transitory. I mean, that's epic and will go down in history, by the way. I guess he was looking ahead when he made those comments, Tom Bowley writes. He and his band of wafflers looked ahead, which is all the Fed heads, and they all got it wrong. Then inflation data poured in higher than expected for months, and then he finally started his data dependency talk. So the Fed, Tom goes on to write, The Fed has been late to every single party for 7 years now and running. And he is right about that. They're running late again, and I completely agree. Eventually, Mr. Waffler, which is Jerome Powell, will get it right, and all our major industries will all move to all-time highs. For now, though, the reason for any period of consolidation, or worse yet, selling, can be laid at the doorstep of none other than the Waffler. So if we do get a sell-off and it's not a good situation in the equity markets, you can basically blame Jerome Powell for it. Personally, I'm exhausted by the constant, quote, listen to what I say until I change it, end quote, approach to the interest rate policy. Yes, we've had a 100-year pandemic and a resulting inflation problem that's been worse than any since the 1970s because we put too much money into the system. Hello, and Jerome Powell was there when that happened. We've had 2 trade wars. I get it. But I firmly believe that the extreme volatility and the 4 cyclical bear markets that we've endured since the Waffler became Fed chief is, in large part, his fault. He was sworn in on February 5th, 2018, and the stock market has been on a roller coaster ever since. Name the last time that the U.S. has seen 4 different cyclical bear markets, all starting from all-time highs within a 7-year period. Start the Jeopardy music. It's there. It's not there. His mismanagement of interest rates didn't start with the pandemic. And this is what Tom wrote. He said, it continues on. I wrote in an article December 2018 during his first year saying that his call for 2 rate hikes in 2019 would never happen. The next interest rate move, I cut several months later in 2019. Here's the article I wrote back as we bottomed in December of 2018. And he goes on and shares that how the Grinch stole Christmas featuring Jerome Powell. I remember this. This is Brent talking. I remember this because it was like the middle of October, like the 19th or the 21st or something of 2018. He started to raise rates. He raised rates like 1% in a very short period of time. He caused a 20.1% decline in the S&P 500 from October to December. And then it was like December 18th in my mind, I recall, but we'll all read what he wrote then. But he straight up pivoted and basically backed off and did the rate cutting thing, which allowed the market to be saved from an absolute calamity because he was causing too much tightness too quickly and he felt like he was late after the prior move. It's just insane. This guy just can't figure it out on when to raise and when to lower, and he doesn't use his intuition. He just is data dependent or whatever BS he throws out there. So let's go on what Tom wrote. He says, How the Grinch Stole Christmas featuring Jerome Powell. No one has ever been wrong more than the Waffler. Now, maybe you're sitting back and saying, Tom, what's the big deal? Now, remember, this was an article written in December of 2018 by Tom. The tariffs are a threat. Why not just wait it out and be sure there are no lingering inflationary pressures? Well, if you don't mind the potential of a 5th cyclical bear market before we finally boot this guy to the curb, then I've got to say go for it. Why try to hasten an economic meltdown when it's unnecessary? Who believes anything the Waffler says? He said we're going to get 2 rate hikes in 2019. We got an interest rate cut instead. He said inflation was transitory in 2021. Then the Fed had to start raising rates at an absurd rate because inflation skyrocketed and he waited way too long to turn hawkish. The stock market bottomed in June of 2022 and was returning back towards all-time highs just prior to his infamous, quote, more pain ahead, end quote, speech from Jackson Hole, Wyoming on August 26, 2022. Subsequent to that speech, the stock market fell precipitously for 2 months before once again finding a new bottom. That entire selling episode was caused solely by his irresponsible remarks. And now where are we? Holding rates steady while the European Central Bank, the ECB, across the pond, has cut rates for 8 straight meetings. The Waffler will eventually get it right. Unfortunately, a lot of innocent investors and traders will continue to pay the price until someone finally shows him the exit. His term expiration cannot get here soon enough for me. Good riddance, Mr. Waffler. And then Tom goes on to write about market manipulation. I won't go over that, but great article, Tom Bowley. Well done. And I picked this up via stockcharts.com. He's the chief market strategist of earningsbeat.com. This was published on June 19th. So if you're interested, you could look him up and go to that website and check him out. All right, on to the next segment. Understanding the nuances of stock options versus RSUs or restricted stock units. Equity compensation can be one of the most powerful components of a total compensation package, especially for those in executive or senior roles. However, even seasoned professionals may not always be completely clear on how different forms of equity work or how to plan around them. Two of the most common forms are stock options and restricted stock units or RSUs. Are designed to attract, retain, and incentivize key executives. They operate differently, and understanding those differences is key to aligning them with your broader financial goals. So, stock options, these give you the right, but not the obligation, to purchase a set number of company shares at a fixed strike price. After a vesting period, their value is entirely dependent on the stock price exceeding that strike price. If it doesn't, the options may be worth little or nothing. Key features of stock options include, but not limited to, provide the right, not the obligation to buy company shares at a fixed stock price, only has value if the stock price exceeds the strike price, typically vests over several years, for example, 25% per year for 4 years. Become liquid when you exercise the option and sell the shares, requires a buyer or a market in order to do that. Might be taxed at exercise for NSOs. Any future gains are taxed at sale, either short or long-term capital gains, depending on the holding period. May be granted by private companies, but liquidity usually requires a future event like an IPO or an acquisition. So there you have it for stock options. So let's dive into restricted stock units or RSUs. They're a promise to deliver shares once specific criteria are met, even and often time-based or performance-based, okay? Unlike options, they don't require a purchase. Once vested, they're yours. So what do? We got some bullet points to go over. Grant shares outright after vesting. No purchase required. Vesting may be based on time, performance goals, or both. Taxed as ordinary income at vesting, based on the share value at that time. If you hold the shares after vesting, any additional gain is taxed at capital gains rates, long term if held for 12 or more months, for example. May also be issued by private companies, but shares often can't be sold until a liquidity event occurs. Both instruments have their place and come with personal finance implications, including how they factor into cash flow, tax management, and investment decisions. The key is understanding what you have and what that means for the rest of your financial picture. If you already have options or RSUs and or are evaluating a new opportunity, we'd be happy to help you access their value and role in your broader strategy. After some initial work, a tax, legal, and or accounting professional can help you better understand any future tax implications. Feel free to reach out with questions or to schedule a conversation with Northbound Wealth Management. Your host, Brent Foster. Ever heard of luxury home swapping? If you own a second home or are open to renting out your primary one while you travel, you might be interested in this unique platform that we recently came across. It's called Third Home. It's a luxury home exchange network that allows you to deposit unused weeks in your property and earn credits that you can use to rent luxury homes, even if no one ends up staying in your home. It has the following interesting benefits. You don't need to consolidate a direct swap. Your credits can be used to stay in thousands of high-end properties worldwide. You pay only a relatively small exchange fee, a lot less than the cost of renting the equivalent type of property for a week. As financial professionals, we're always looking for strategies to help our clients manage their assets well, and this one strategy we found was worth sharing. Has anyone heard of this arrangement? If so, give us a shout. Let us know what your thoughts are on this luxury home swapping situation or opportunity. It's interesting. All right, next up. Did you know that the top 10% of earners account for nearly half of U.S. consumer spending? According to a 2025 report in the Wall Street Journal, high earners, those making $250,000 or more, are keeping the economy afloat while much of the country tightens its belt. Here are a few key takeaways. The top 10% now drive 50% of consumer spending. That's up from 36% in the 1990s. The top 10% spent 10% more on luxury goods abroad compared to the prior year. This creates risk if wealthy households scale back their spending due to market declines. The effects could ripple throughout the broader economy. Spending power is more concentrated than ever, making the economy more vulnerable to the behaviors of a small group. As this trend continues, it is worth watching how shifts in markets or inflation might impact consumer spending and economic resilience. So keep that in mind as you go out and about and look for deals and opportunities and evaluate the economy. All right, next up, what's the one subject your kids won't learn in school but absolutely should? Any guesses? It's financial literacy. Help them learn with some quick tips from Barron's 6 Steps to Raising Money Savvy Children. Start them young, introduce basic money concepts to them early, and give them a strong foundation. That seems obvious, right? Number 2, introduce them to investing. Teach older children about investing to help them understand risk and return. Number 3, offer them incentives. Encourage them to save by matching their savings or setting goals for them to reach with corresponding rewards. Number 4, give tweens and teens more responsibility. Empower them, right? Allow them to manage a budget for certain expenses to foster independence. Number 5, discuss college costs with them. Have open conversations with them about funding education and the implications of student loans. Number 6, keep the conversation going. Make financial discussions a regular part of your family life to reinforce your children's learning. Teaching your children financial literacy today helps them build a confident and responsible future. It's never too early or late to start. Do you agree with all these? Do you think that Barron's is putting it out there right? I think so. Smart Money, Smart Kids by Dave Ramsey and Michelle Cruz, his daughter, I think is another really good book. Or Managing Money God's Way is another good one. But nevertheless, teach your kids about finances or the world will. Back to basics, an inside look at asset allocation. Whether your investment time horizon is years away or right around the corner, your portfolio should be designed with your financial goals in mind. Given the volatility we've experienced in recent years, we wanted to reach out and review some investment concepts that have stood the test of time. Let's start with asset allocation. So, what is asset allocation? Asset allocation balances investment risks and reward as you build your portfolio, creating a mix of asset types based on your goals, risk tolerance, and time horizon. Asset allocation is an approach to help manage investment risk. It does not guarantee against investment loss, but put simply, there are many asset classes, each with a different risk or reward potential. These may range from simple to more complex financial strategies. Each asset class has risks and rewards depending on your time horizon and financial goals. So finding a balance when it comes to managing your portfolio, asset allocation can require a hands-on approach. Setting it and forgetting it may sound appealing, but changes in markets may warrant a portfolio review to determine if your initial asset allocation still makes sense. A financial professional like Northbound Wealth Management can help guide you through the process and help you adjust to any changes that life throws your way. If you'd like to discuss any of this further, please give Northbound Wealth Management a call or send our team an email. We look forward to hearing from you. Back to basics. Warren Buffett on emotion and investing. If you're anxious about market volatility, you might take comfort from one of my favorite quotes on investing. The thing to do is to keep your mind when the world around you is losing theirs. End quote. That was a Warren Buffett ism. Here are a few tips to help you follow Mr. Buffett's advice. Don't focus on daily movements. With today's 24/7 news cycle, it's hard to avoid financial news. Try instead to focus on your investment goals and tune out the daily or, worse yet, hourly swings. Keep your sense of history. What looks scary now may not seem so bad if you take a step back and look at the bigger picture. Be wary of easy answers. So, well meaning friends or popular financial articles may offer ideas, but hasty money moves are often costly in the long run. Markets move in cycles, meaning they have ups and downs along the way. Some market watchers would even suggest down cycles are healthy in the long run. That said, downtrends can be unnerving, and sometimes they may cause you to rethink how you feel about market risk. Managing your emotions during good times is just as important. Ultimately, taking a long-term view of the markets is essential when pursuing your long-term goals. You can reach out to us via email or give us a call. Northbound Wealth Management, 317-399-1107. And we can help discuss how to manage emotional sides of investing and financial decisions. And we understand market cycles and how various choices you make might impact your portfolio over time. So we look forward to hearing from you. Back to the basics. Time in the market, not timing the market. You guys may have already heard this one. There are many reasons investors consider pulling back from the markets. Inflation, interest rates, troubling headlines, and market volatility are just a few. However, trying to time the markets to avoid the downside while gaining from the upside is challenging, even for professional investors. Market timing is so hard because some of the most significant gains or stocks can happen when you least expect it, while some of the worst days occur when everything seems to be going great. Plus, market timing forces you to be right twice, once on the way out and a second time on the way back in. So sticking to a strategy, while everyone's situation is different, there's an old Wall Street saying to remember for situations like this. The saying goes, it's not market timing, it's time in the market. A portfolio that reflects an individual's time horizon, risk tolerance, and goals anticipates periods of market volatility. Keyword, anticipates it, understands it. Remember, don't let short-term market moves distract you from your carefully crafted financial strategy. When markets turn volatile, keep your emotions in check and focus on your overall investing approach. In the meantime, you can always give us a call or send us an email to discuss what's going on with financial markets. We look forward to hearing from you here at Northbound Wealth Management, 317-399-1107, or check us out at www.northboundwealth.com. Back to the basics. The value of financial professionals. So, predictability is a scarce commodity when it comes to finances and investment. Managing investment accounts, retirement strategy, day-to-day finances can get demanding and stressful, even for the most confident investors. This is where a financial professional like Northbound Wealth Management and our team can provide guidance and insights. In fact, 83% of those who work with a financial professional believe they have less financial stress. Financial professionals can provide insights into retirement strategies and investment approaches. By enlisting a trained professional, you're choosing to meet these uncertainties with an informed strategy and help maintain a positive outlook during periods of market volatility. A professional perspective. So, here at Northbound Wealth Management, we can help guide investors in many ways, including goal setting. One benefit of using someone like Northbound Wealth is to help you articulate your goals and determine which are the most important to you. People like us can help turn those goals into an investment strategy aligned with your risk tolerance. Insight is another one. A licensed financial professional can help you with many issues, including saving for college, retirement, and overall investment needs. Research. Many financial professionals work with a team of other professionals with access to research and industry resources to help determine what investment opportunities may fit your specific situation. Objectivity. So your people like Northbound Wealth Management can help remove some of the emotion of investing. They can keep you focused and help you manage mistakes that might undo your overall financial strategy, help you not make dumb decisions, for example. Guidance. A financial professional can provide strategies to relieve you to focus more energy on other parts of your life. If it's time to start working with someone like Northbound Wealth Management or financial professional, or evaluate alternatives to your current approach, please give us a call. Northbound Wealth Management, 317-399-1107, or send us an email or reach out to us on the Contact Us page on our company website, northboundwealth.com, and we'll be in touch. Back to basics. Schedule a complimentary financial assessment. Fancy way of saying just reach out. Schedule a complimentary review. Trying to manage your investments and overall financial future on your own can be a daunting proposition. That's where we come in. Whether you're looking to begin a relationship with your first financial professional or think it's time to move on from an existing relationship, we're here to help. It starts with a call. All relationships start by getting to know one another. The first step is to schedule a brief call, maybe 15 minutes, to determine whether we can help with your needs. If we both agree there is a potential fit, the next step is to schedule a preliminary meeting in our office or virtually, like on Zoom or something like that. Complimentary assessment. During this meeting, we will begin gathering information for a no obligation complimentary assessment where we will learn about your values, financial goals, and investment objectives. We'll discuss what is most important to you and your family by asking questions about how you envision your retirement and what financial issues are causing you stress. So we obviously want to deal with what's causing you stress right now or at the moment. After getting to know you, we will complete an assessment and develop a detailed strategy to help you pursue your financial goals. And then we'll invite you back to review our approach and answer all your questions. If you're comfortable with our strategy and recommendations, you can partner with us as a client, and we will begin our work over the long term. Let's connect. If you're looking for a financial professional with a customized approach to creating strategies that address your goals and dreams, it's time to take this critical step. We look forward to hearing from you here at Northbound Wealth Management, 317-399-1107, or reach out to us on the website. We'd be happy to take an email from you and schedule a complimentary call. All right, thanks for tuning in. Take care.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.